The sound of a subway signals stacks of gold. That Chinese motto could be why China has one of the most massive metro systems in the entire world. Hundreds of thousands of riders, grand real estate property, and a bustling economy is what every developer's dream of when subway stations pop up on city streets. So Chinese cities should be raking in the cash with all that subway rail, right? Well, not quite. Let's dig into how Chinese metros make their money. They say when life gives you lemons, make lemonade. And in terms of subways, China's biggest cities seem to have got all the lemons. That sort of idea came from the director of the China Urbanization Research Center at Beijing Jiaotong University. His name is Zhao Jian. He told China Newsweek that, quote, for an average Chinese city, subways mostly operate at a loss. Medium and small cities, even some big cities, don't have much building space. He added that only the major metropolises of China have such physical space for subway construction. Other than physical space concerns, Zhao Jian outright warned that most cities simply don't need subways. He said building them costs a lot, and so does operating them. But seemingly, many cities have not at all considered this reality. According to the Ministry of Transportation, 54 Chinese cities have opened and operated urban rail transit systems, with nearly 10,000 kilometers or 6,200 miles of track in use. But that track costs quite a bit to own and operate. Estimates put a price tag ranging between 800 million to 1 billion yuan up to $140 million per kilometer of track. So where does that gold saying come from? That's from the way subways can increase property value around the areas they operate. And numerous cities have put themselves in debt in hopes of building a transportation-focused city. One of the 6 large cities in coastal Zhejiang province, Ningbo, built subway stations on land that had been deemed permanent basic farmland. They took out loans and added to public debt for the construction job. The local government's justification for the construction was them taking part in so-called advanced planning. Zhao Jian illustrated the potential pitfall of this sort of advanced planning. He said that though subways increase land value, it's often at a loss for the initial investor. That's because the people who spend money to build the subway infrastructure won't recoup their investment. Instead, it's the people who own land around the subway that will see an increase in land values. Zhao added that, on top of that, physical limitations make it so high-density construction can't be put up around new stations. So if there is so much financial difficulty surrounding subways, why are so many cities pursuing building and expanding them? On one side, it's a status symbol of a city's affluence and prosperity. And for the Chinese Communist Party, or CCP, face is everything. On the other side, all of the warnings may just be pessimistic business outlooks. Many of these Chinese subways appear to be operating profitable businesses. That's according to data compiled by mainland Chinese media outlet Jiemian News. After gathering financial data for 24 cities' subway systems, they found that only 2 of them were operating without making profits. But that's with one major condition. Those profits included government subsidies, big subsidies. If government subsidies are not counted in a subway system's net revenue, the picture almost flips upside down. Only 5 subway systems remain profitable, and suddenly 19 are operating in the red. Other data says only 7 of the 40-plus total subway systems in the country are profitable. Either way, about 1 in 5 of the subway systems in China are making money. So let's look at 2 major subway systems, both in terms of size and profitability, Beijing and Shenzhen. In 2022, Shenzhen's subway system took the #1 revenue position away from Beijing's metro. In fact, Shenzhen didn't just go by Beijing, it simply blew right past the capital city. Last year, Shenzhen's metro earned just under 24 billion yuan, equal to $3.3 billion US. That number soared from 2021 by about 7.6 billion yuan, over $1 billion US. In that same time frame, Beijing dropped by about 15 billion yuan, just over $2 billion US. Now, let's look at the subsidies they received. In 2022, Shenzhen received around 530 million yuan in government subsidies. By comparison, Beijing's 15 billion yuan revenue was overshadowed by nearly double that in government subsidies, 26 billion yuan, or over $3.5 billion US. But that's just looking at revenue and subsidies. What really matters for business is profitability. Shenzhen crossed just past 1 billion yuan in profits, or about 137 million US dollars. Beijing, on the other hand, nearly doubled that, with 2.1 billion yuan, around 300 million US dollars. It seems like business is good, right? Let's look at what happens when we take away one of the key forms of income we talked about earlier, government subsidies. When excluding subsidies from a subway system's revenue, Shenzhen wasn't the most overall profitable metro. It came in second overall at 500 million yuan or 69 million US dollars. Only Wuhan landed ahead, short of 1.5 billion yuan. Beijing, on the other hand, saw a disastrous loss of 24 billion yuan. It was by far the worst performing subway in terms of profitability. The next closest subway system in the red was Hangzhou, which did about 3 times less badly than Beijing, losing 8.7 billion yuan in profits. That goes to show that in terms of business, Shenzhen is doing something right, while Beijing is an abject failure. Despite government support nearly tripling for Shenzhen in the 2021-22 time period, the system seemingly can operate on its own. Beijing's metro, on the other hand, would be 6 feet under without government handouts. So what causes this stark contrast? Most of it comes down to operating costs and maintenance. According to a report from China Business News, in 2020, the Beijing metro spent about 5 billion yuan for labor and another 5 billion yuan for electricity and maintenance, about $700 million each. For the same year, operating its lines cost the metro about 13 yuan per person, while the fare sat at 4.5 yuan per ride. Shenzhen, coincidentally, has fares at a similar rate. So what is Shenzhen doing differently? Looking at fares alone, Shenzhen would also be operating at a loss. In fact, none of the subways are profitable on fares alone. What Shenzhen does, or did, is how the subway integrated with the rest of the city. Shenzhen is profitable because of the subway integrating business both above and below ground. The transit-oriented development has allowed the subway to thrive through a symbiotic relationship with local businesses. Without that, ticket sales alone cannot make a subway survive. When looking at Shenzhen's revenue sources for 2021, less than a quarter of the money it earned was from ride fare and ticket sales. On the other hand, over half of the money came from how the station integrated into the city. From another perspective, the Shenzhen Metro is more real estate developer than public transportation. By comparison, Shenzhen's real estate income doubled that of Beijing. Other cities have learned from Shenzhen. Wuhan has seemingly followed Shenzhen's model so well that it came in first for profits, as we mentioned earlier. But it is worth noting that while Shenzhen's total revenue was higher than Wuhan, its operating costs dropped down to second place. So, since it's no secret that operating a subway is a costly endeavor for the government, how do cities get permission to sink money into these projects? That's up to the National Development and Reform Commission, or NDRC for short. It's responsible for controlling the Chinese economy. When a city wants to upgrade its rail system, the NDRC gives permission. As of September 11th, the NDRC has granted permission to 3 cities to expand their subway systems for this year. We'll come back to who those cities are in a moment. Cities can file for new construction applications after existing jobs are finished, usually in a 5 to 6 year cycle. Many cities are heading toward finishing their current round of expansion projects, with many forecasted to end in 2023 and 24. According to incomplete statistics, at least 50 cities have published applications for subway construction projects this year. So, amidst China's recent economic downturn, plus the knowledge that subways are generally financial burdens on local governments, how will the NDRC respond? Well, the only response actually happened 5 years ago. In 2018, the NDRC imposed stricter measures to permit new subway construction. That year, they issued their, quote, opinions on further strengthening urban rail transit planning and construction management. Those opinions raised previous requirements that a city had to meet for permission to expand their metro services. That effectively raised the difficulty for any city to either build or expand a subway system. Even director of the NDRC's Urban Transportation Research Center, Cheng Shidong, indirectly confirmed this point when he told China Newsweek that the approval rate had already peaked in previous years. He added that the deciding factor would be if localities have the ability to keep putting funds into the projects. Based on the government mandate alone, the NDRC appears to have directed China to a conservative era of subway building. As a result, subway construction and expansion may be limited to only cities that have existing infrastructure. But even cities with infrastructure are scaling back. Some of those include Hangzhou decreasing its planned new lines from 13 down to 9. Chengdu saw a massive cut in plans, reducing its planned subway lines from 55 down to 36, a drop of 19 lines. As for what requirements the NDRC raised for cities, some of those include local GDP, population size, and traffic intensity on the subway. China calculates this traffic intensity as the number of riders per day for every kilometer of subway track. The NDRC's newly required number is, at minimum, 10,000 riders per 1 kilometer of track. Using that calculation, only 8 of the country's subway systems are above the newly set standard for traffic intensity. Both Beijing and Shenzhen are on that list. The other 33 systems fall below, some far below. But if there's one thing that's sure about the CCP, it's that it only follows rules when it's convenient for itself. That's especially true when it comes to profitable ventures. Remember Cheng Shidong, the transportation director who worked under the NDRC from before? He told China Newsweek, quote, "If cities don't meet requirements, they certainly won't be approved." It turns out one of the 3 cities that received NDRC approval this year also has one of the lowest traffic intensity ratios. That city is Shaoxing. It came in 30th place out of 33 cities that fell below the traffic intensity standard. Shaoxing is another one of the 6 large cities in Zhejiang. Its subway has about 114,000 riders per 38 kilometers of track. That comes out to a traffic intensity ratio of 3,000, far below the needed 10,000. So why are the rules being bent for Shaoxing? It could be because it's bordering on profitability itself. In 2022, minus government subsidies, the Shaoxing Metro only lost 6 million yuan, about $820,000 US. The number pales in comparison to the 24 billion loss suffered by Beijing. In fact, Shaoxing was the closest to being profitable. Maybe money was the only persuasion the CCP officials needed. After all, Cheng Shidong said the deciding factor was local funds. Nonetheless, along with Shaoxing, the other 2 cities which have received permission for subway expansions this year are none other than Shenzhen and Beijing. While Shenzhen has proven that it can run its business well, perhaps the capital city needs to ensure that its status symbol continues growing to keep up the facade of a prosperous China. So it really might be the case that the sound of a subway signals stacks of gold. It's just a question of, will someone be earning that gold or paying it instead?